Poverty remains a huge challenge across the globe. When people struggle with low incomes and limited opportunities, it's easy to wonder, if money is the problem, why don't governments just print more of it? Wouldn't that make everyone wealthier and happier? It sounds simple, but the reality is far more complicated. Let's break it down. What really happens when a country prints money? When a government prints money, it increases the amount of currency in circulation. But unless there's a matching increase in goods and services, like food, cars, houses, or technology, that extra money only creates more demand for the same limited supply. What happens next is called inflation. Inflation means prices go up because there are more dollars chasing the same products. And if this cycle spins out of control, prices can rise not just year by year, but week by week, or even hour by hour, a nightmare called hyperinflation. A simple coffee example. Imagine a cup of coffee costs $3. 10 people each have $3, and the cafe has exactly 10 cups ready. Everyone buys one cup, no problem. Now suppose the government suddenly gives everyone an extra $3. Each person now has $6, but the cafe still has only 10 cups. People start offering to pay more to make sure they get their caffeine fix. Seeing the rush, the cafe raises the price to $6 per cup. In the end, everyone still drinks just one cup of coffee, but they now pay double for it. They aren't richer. The money simply lost value. This isn't just theory. History offers painful lessons. Weimar Germany, 1920s. After World War I, Germany was crushed by war reparations and a broken economy. To pay its debts, the new Weimar government kept printing banknotes. At first, it seemed to help. Debts were paid, salaries were distributed, but prices began climbing faster than wages. By late 1923, prices doubled every few hours. People carried wheelbarrows of cash just to buy everyday goods. Children played with stacks of worthless bills because toys were cheaper than paper money, creating social chaos that paved the way for extremist politics. Zimbabwe, 2008. Nearly a century later, Zimbabwe repeated the same mistake. Land reforms, poor harvests, and international sanctions devastated food production and government revenue. Instead of tackling the root problems, the government printed money to cover expenses. Inflation exploded to an almost unimaginable 89.7 sextillion% per year. That's an 89 followed by 20 zeros. A loaf of bread could cost millions of Zimbabwean dollars in the morning and billions by evening. Citizens carried bags of cash just to buy a few eggs. And eventually, the local currency became so worthless that people used foreign currencies like the US dollar instead. Venezuela, 2016. Even resource-rich countries aren't immune. Venezuela, owner of the world's largest oil reserves, enjoyed years of high oil prices and generous government subsidies. But when oil prices collapsed after 2008, revenues dried up. Rather than cutting spending or diversifying the economy, leaders kept printing money to fund subsidies. By 2016, hyperinflation made the bolívar practically worthless. Prices could double within a single day. Citizens abandoned the currency, turning to US dollars, gold, or even cryptocurrencies just to survive. These disasters show that printing money doesn't create wealth, it destroys it. When a currency loses credibility, people rush to exchange it for anything with real value. Foreign money, gold, food, or even coffee beans, just to preserve their purchasing power. Why printing to pay debt also fails? Some might argue, what if a government only prints money to pay its foreign creditors? Wouldn't that be safer? Unfortunately, the global financial system notices quickly. Economic reports, currency markets, and inflation data reveal any sudden increase in money supply. As confidence in the currency drops, exchange rates fall, and foreign creditors demand repayment in more stable currencies. Even if the intention is to pay off debt, printing money still devalues the currency and damages the nation's economic reputation. If printing money doesn't work, what does? Real wealth comes from creating value, not from creating paper. Governments need to invest in education to build a skilled workforce, develop infrastructure to support trade and industry, encourage entrepreneurship and technology to expand production, manage resources responsibly to maintain stable growth. When businesses produce more goods and services, jobs are created, wages rise naturally, and prices remain stable. People earn money by adding value, not by printing it, and they spend it more carefully because it represents real work. This is the path countries like Japan and South Korea followed: manufacturing and human capital instead of relying on money printing. The result? strong economies, and stable currencies. Printing money might look like a quick fix for poverty and economic crisis, but history shows it almost always leads to higher prices, weaker currencies, and widespread hardship. Money is only useful if it can buy real goods and services. If production doesn't grow, more money simply means less value per dollar. So the next time someone suggests just print more money, remember the coffee cup, the wheelbarrows of cash, and the painful lessons of history. True prosperity isn't printed, it's built. If you enjoyed this explanation and want more insights into economics and finance, don't forget to like this video and subscribe for more deep dives. Thanks for watching.